Banks do not care about these things. One of the main things that I constantly hear from people is all you need is a good credit score, whether on the personal or on the business side, and you're good to go when it comes to getting access to business capital. But what I'm going to share with you in this video is going to serve you far better than just aiming for an 800 credit score, and it's going to serve you far better than just aiming for a 70, 80, even a 90 paydex score. I want to share with you what actually makes the needle move, but I first want to start out with some misconceptions that we tend to hear, maybe from just speaking to people that maybe don't know enough about the subject, or just constantly maybe seeking information online. And again, it doesn't maybe come from a well-versed source. And so our credibility to be able to speak from the subject matter is we've been able to consistently help clients get access to anywhere between 75 all the way upwards of $500,000 in working capital by helping them properly structure out their businesses, not just looking at their credit scores or not just looking at their personal credit scores, but looking at the entire picture holistically. And so I want to share with you why just looking at, and the reason why I'm going to use the Paydex score isn't necessarily a benchmark metric or KPI that you solely want to focus on. Here's why. One of the first things that I tend to see whenever we are either potentially bringing on a client that applies to work with us, or when we are going through the initial onboarding and auditing process of a client's just the all-around profile of their structure and again their business as a whole, is they always say, Irv, I have, an 80 Paydex score. Now, if you have no idea what an 80 Paydex score is, let me kind of give you that so we can at least lay the foundation to be able to, again, have common speak here, right? And so an 80 Paydex score, or rather a Paydex score, is the main Paydex score that you're going to get from Dun and Bradstreet. Now, this is what I would consider, not really, my opinion, but an actual fact. This is the most well-known score, and it's issued by Dun & Bradstreet, who is the largest business credit bureau, right? I think that this is the main reason why so many of us tend to focus on, and when I say us, I mean business owners tend to focus on the Paydex score because it's the one that, again, everyone knows. Now, this score, if I'm being real with you, ranks the lowest, and it really doesn't make a difference of what banks and financial institutions are actually looking at. And you're wondering, Irv, why is that? Like, all I hear, especially if you're maybe on YouTube land or if you're used to buying maybe business credit courses here and there, is get the 80 Paydex score, get the 80 Paydex score, get the 80 Paydex score, right? But the Paydex score alone is only geared toward vendors and suppliers. It's only geared toward vendor and suppliers. Financial credit and trade or financial credit, I should say, and trade credit are not weighed equally. It's not an even exchange. And so the way that the 80 Paydex score works is you have at least 3 to 4 vendor accounts. That's maybe Uline, Quill, Granger, just naming the most popular ones off the top of my head. So think of it as supplier credit, which means, let's say you get $1,000 at Uline, or you get $1,000 at Home Depot. You can only use those $1,000 at that store or with that company. And so the way that it works is you're going to get what's called a net invoice or a net payment term on there, which means if, let's say today was the first and you made that purchase for your business using that trade credit from them or that vendor credit or that supplier credit, it's all essentially the same. You have 30 days from the day that you were invoiced, which in this case was the first, to make that payment. Now, if it's 45 days to make that payment, that's a net 45. If it's 15 days to make that payment, so let's say you bought some items on the 1st, you have until the 16th to make that payment, that's a net 15. So whatever that number is, just put a net dash in front of it, and that's ultimately what a net payment is, or a net term. Having a high Paydex score, having a Paydex score alone does not lessen the importance of other key metrics that underwriters want to look at, which is what I'm going to be sharing with you in this video. It's going to serve you far better than just aiming for the score. Now, am I going to completely discredit a Paydex score if you're looking for some maybe EIN only products? No, absolutely not. Here's why. this is going to be completely based on what your goals are of how you want to run your business. And so we were working with a company that was involved in government contracting. And for them, did having or, was having financial trade lines. So that's your traditional business credit cards that you're personally guaranteeing for. Was that a benefit for them? Yes. But upon further conversation with this business owner, he mentioned, Irv, if I can just get net 60 terms on some of these suppliers, I'm good because we can turn some of these contracts in pretty quickly with how fast his contracts were getting paid out. I think he was getting paid out like on a net 14, which is really fast. That's actually really good, especially in the government contracting space. And so in that situation, did it matter if it was just maybe a net term? No. But I think that for the majority of us that maybe aren't in that line of work where we need what's called real cash value credit, that's where the paydex score, I believe, falls short because, again, it's not a key metric that banks are looking at during the underwriting process, right? Moving on to your credit score, which is the second thing that I see a lot of people overly focus on, and it doesn't tell the full picture. Credit scores don't tell the whole story. They don't. Here's what I mean by that. I want you to think of a credit score kind of like someone's weight, where without any context, the score can be completely misleading. Have you ever looked at, and this is maybe just my sports background, grew up playing baseball, collegiate athlete. I still like to work out recreationally just because I enjoy getting a good sweat. And so I'm really good. Like if you ask my wife, I'm pretty, like I should probably have like a like a night shift working at a circus somewhere. It's kind of freaky. Here's what I mean by that. I'm pretty good at guessing someone's weight just based off of their body comp. And so I actually did that at an event that I was at about 2 weeks ago. There was two guys there, pretty good shape. I said, "How tall are you?" 5'11". You look like you're about 240. He says, "I actually am 240." There's another guy there. I said, "You're a little taller than me. I'm only 5'10 and a half. You look like you're about 6'1". I mean, you're built like a unit. You must be about 270, right? Irv, why are you saying this? Like, what the heck does this have to do with credit? If you look at two profiles, person A has a 700 credit score, person B has a 700 credit score. On paper, that looks identical. But upon, again, further review, person A has one trade line and an authorized user, right? So they have an actual account that belongs to them, right? That's known as a primary. Person B has 5 primaries. They have a mortgage in their name, and they also have a vehicle auto loan that's in their name. It's all being paid on time. The only difference is between both accounts is maybe the utilization is a little bit higher on the person that has more active credit lines. Now, if you ask me, based off of all of the files that we've seen and what bankers look at, and again, these data points comes from the clients that we deal with, and so you're getting real-time data based off of what banks are currently doing right now at the time of this video, is they are going to disregard the 700 credit score on the person that only has one account, especially for the purposes of guaranteeing or personally guaranteeing debt on behalf of the business, which is where 99.9% of us are going to land if you're essentially generating under $4 million in revenue and you're not looking to put up any collateral on behalf of your business. Then your personal credit score is very much so going to be a factor, or your personal credit report in this case is going to be a factor, or your profile, I should say, not report. Your credit profile is going to essentially do the majority of the heavy lifting. The byproduct of the profile as a whole is the score. And so that's why I wanted to, go back in with my opening example, where if you have one person that's 150 pounds, you have another person that's 150 pounds, but one person works out 4 times a week. They are consistently doing cardio 3 times a week. They're watching their eating habits. They don't smoke. They don't drink. They get their, they go out to, they go to bed on time every day. You have the other person that is inactive, doesn't have the healthiest diet. You put both those people on a track. The person that is obviously staying in shape, that their physical life is going to obviously tell the key difference once they're out there. That's ultimately what's going to get judged, and that's what's going to get weighed if they were to, let's say, go out and have a race. So the credit score can be artificially inflated. And one of the ways that it's artificially inflated is by, drumroll please, by simply just adding a bunch of authorized users, which after 2 authorized users on your profile, you start to get diminishing returns for the purposes of again, properly structuring your credit the way that the banks want to see it. The third piece that it honestly doesn't matter to the banks when you're looking to get access to working capital is your fancy corporate structure. Fancy corporate structures do not move the needle, ladies and gents. Here's why. Complex structures set up in places like Wyoming, Delaware, Nevada, that probably rings a bell for you because it's, again, it's the fad. It's most likely what you see out there. Trust managed by a company that owns an S corp, which directs into an LLC that then compensates you. Again, there's videos out there, and I'm not saying that they're wrong. Here's what I'm gonna say, and it's gonna come in the next slide. And I'm gonna, preface by saying this: if you don't understand why you're set up the way that you are, then what's gonna end up happening is that when you do decide to go and get yourself a working line of credit of 100K, a 6-figure round, 250K, whatever that threshold is, it's different for all of us, right? The moment that you get pressed a little bit by maybe a private banker or a financial institution that wants to know, remember, they're grading on 3 aspects. They're grading on the cash flow of the business, they're grading on the credits of the business and the business owner, and then another metric that they look at, really there's a fourth. Third is collateral. The fourth is the character of the business owner. And so they want to know, hey, the person that we're lending money to, even though it's on behalf of the business, you're the representative. Do they actually know why they're structured the way that they are? And if you just had someone set it up for you, I always tell my clients, hey, have at least a baseline understanding of why you're set up the way that you are. So that way you can continue to scale this thing, which is something that we work diligently on with them. We're not just going to do it for you. We're going to show you why it's being done this way, and we're going to educate you along the process. Aged and shelf corporations claiming to guarantee credit based on their age is the third, and I'm going to put quotation marks around this, fancy corporate structure that we tend to get. There is no bypassing this right here, which is what we all need to focus on as business owners. Now, if you don't care about running a legitimate, profitable business, this video isn't for you. If you don't care about properly scaling your business capital apart from a measly first round, 50,000, 100,000, and I say measly just because I think that that's baseline of where most of our clients start out at. Obviously, everyone starts somewhere, but if you're running a legitimate business, then you know that capital goes away pretty quickly when you're allocating it. And so you're not just stopping at 50K. You're not just stopping at 100K. You're not just, we have business owners that they're not just stopping at $500,000, right? They're working their way into that seven figures worth of working capital because, again, it's about sustainability and it's about predictability. Getting access to working capital is not going to be a one-time event. It's an ongoing process. And so you want to align yourself with having your business set up in a way that's congruent to your business as a whole. Irv, let's define congruence, please. Congruence is your formation. It's all in line with your cash flow cycles, which is all aligned with your debt allocation strategy, which is in line with the industry alignment with what the bank and the financial institution is looking for. I've probably spoken about this before in other videos, but I'll hit it again. When it comes to cash flow cycles, you want to know when you're going into a peak season or when you're coming out of a peak season, because that'll tell the financial institution everything that they need to know about your line of work. And if you have that ready to go, and if you know when that typically is, and even if you're a brand new startup, if you at least know enough about the industry, because they have stats on this. And so if you're applying for, let's say, working capital, and this is like a big one that flies under the radar, but if you're applying for working capital and you go in the middle of, let's say, November, and statistically, especially, for let's say an industry that is just, it's downtime, then what's going to happen is you're either going to get approved for week limits or you're going to get denied altogether, even if everything else is lined up as a whole. Versus if you go in and let's say you're applying for working capital, and this is one of the ways that we structure it based off of cash flow cycles, and we're going in with a client who has the same e-commerce store, then we know that e-commerce and retail, again, we're just looking off of trends and statistically going into Q3 and Q4 are at its highest versus the majority of other industries. Like if you were to compare it to an info space or online education, that's usually lower around November, December, and then January starts to ramp up. It's the exact opposite for retail. And so timing it that way. So if we were going to go in for, let's say it's September right now, and we were going to go in starting in October, then we would properly be timing it based off of cash flow cycles. That's how that works. And if you guys want me to make another video breaking this down, formations, cash flow cycles, debt allocation, industry alignment, the whole nine yard, we can go ahead and like really get down to the sauce of that. But I at least wanted to break down one of those metrics that a lot of us, again, tend to miss, and which is why I'm making this video, so that you're not so that you're not sleeping on this. A credit profile that emphasizes what they deem valuable. That's what you want to focus on, which is the second piece here. That's going to be your pay history and existing credit lines. The reason why I have these on here, and I could maybe add a third, and that would be the total credit usage, which kind of falls in line with what's going to happen with the debt allocation part, is the pay history and the total credit usage makes up about 65% of the profile for the business owner, or the business owners, I should say. If something is making up 65% of anything, then that's maybe a metric that you want to pay attention to. And so in your business, think about anything that makes up 65% of the clientele that you bring in. Maybe something you want to pay attention to. Think of 65% of something that makes your spouse happy, right? If you're quantifying that, if it's quantifiable, maybe something you want to pay attention to. So you know that, hey, anytime I don't take out the trash, my wife probably gets pissed. It's maybe a metric that I want to pay attention to. Anytime that I maybe have been working all day and maybe you've been ignoring your spouse and all you do is you're on your phone, and 65% of the time they're probably going to get pissed. It's probably a metric you want to look at. And so when it comes to pay history, the total usage, and then I'm going to include that third piece on there, which is existing credit lines. Those are three key metrics that the financial institutions are going to look at outside of just the symptom, which is the personal credit score. I want to take you to the root of it all. And then lastly, focus on your business credit ratings, the company's profile, and then the credit scores will follow. And so you have Experian, you have Equifax, and again, these are both on the business side, and then you have your Dun & Bradstreet. Now, if you're wondering, Irv, earlier you mentioned the Paydex score doesn't matter when it comes to getting access to capital at the banks and at the credit unions. So should I just disregard my Dun & Bradstreet altogether? No. What our clients focus on is the rating, and what we help them focus on is the rating. Now, the rating is a byproduct of the overall holistic structure of the business credit profile. That means that they have the right accounts reporting. That means that all of their information is congruent. Their industry is aligned. They have the right industry codes. They have the right number of employees listed. They have a squeaky clean, properly audited business name. So the naming convention's on point. You also have the business's address. That's also been audited and vetted. And all of that flows into the rating. I was actually speaking to a construction business owner yesterday, which is an ideal client that we like to service when it comes to construction-based businesses, real estate. It's just some of the main business owners that we, again, just gravitate toward us and that we can just help really take this thing to the next level. He tells me, Irv, I actually missed out on a lot of capital. I said, why? He said, my credit was around a 780. I said, okay, cool. He says, my business is generating about 500K top line. I said, okay, fantastic. He says, but the banks kept telling me that I was in high risk. And I said, okay, well, it couldn't have been because, and we looked at his classification. I said, it couldn't have been because of the classification. And so he says, no, they mentioned something about a rating. And so I was actually, because he does government contracting as well with the construction-based work, apart from him doing home remodels. And he says that they were actually losing out on a significant amount of bids, not because they were qualified with quality work, but because the government contractors that were going to essentially, or the government issued contracts that they were trying to go for, were going in and pulling their credit ratings on the business side, which lets me know that the business wasn't properly structured, at least in the way that it needed to be conveyed over with the business credit bureaus. Which is, if you go back, listen to what I just said about maybe about a minute and 10 seconds ago, with the list of things from the address to the name to the classification to the number of employees to the revenue that's listed. That whole piece right there is super important, which is why I wanted to give you the business credit ratings. So again, don't just pay attention to the Paydex score, pay attention to the business credit ratings, and then the scores will follow suit. If you found value in this content, and if you actually want a full deep dive on any of these slides that we broke down today, just go ahead and comment that below, whether it was about properly structuring out your credit profile the exact way they want to see it, a little bit more on credit ratings versus just credit scores or structures as a whole. It honestly lets us create content around what you want to see and not what we think you want to see, which makes our lives a heck of a lot easier. We just want to make sure that we're serving you at the highest level. If you need access to working capital, but you want to make sure that you're set up properly, let's jump on a call with my team. You can go ahead and click the link below. Schedule your demo. It's absolutely free. We'll see where you're at, and if you're not ready to work with us just yet, we'll at least leave you with some resources that's going to leave you better off than how you entered into the call. But other than that, I appreciate you guys checking me out. Until next time, everyone, I will see you in the next video. Bye.